In this lesson, we're going to have a look at capital growth and rental yields. So in other words, how do you make money from property? And we're going to define each of those aspects and go into a little bit more detail. So we're going to look at definitions and strategies themselves. We'll look at yield and cash flow. We'll go into a bit more information specifically on appreciation in terms of how properties do appreciate in terms of the influencing factors and how you can potentially combine the best of both worlds. So firstly, when we're looking at properties, right, let's be clear, there are two ways to make money. One of the ways is through rental income. So buying the property, giving it to an agent to rent it for you, and then that tenant paying you rent for the property. The other way is through the property value increasing naturally over time. Now, looking at rental yield, this is fundamentally income generation. So that's what it's focused on. It's focused on how much money is going in your pocket each month. Now, the phrase yield, it refers to the annual income generated from the investment expressed as a percentage of the property price, the purchase price of the property. So, in other words, if you buy a property for 100,000 dirhams and you get a 10,000 dirham return in rental income, it means your rental yield is 10% of that property. Okay, and obviously those numbers are just for demonstration purposes. Now, that's what would be a gross yield. You would then, from that 10,000 dirhams, have things like service charges and maintenance costs. So say that costs, 2,000, then you're left with 8,000. Okay, so then that figure expressed as a percentage would be the net yield of the property. So yield refers to the income that's coming in. It can either be a gross yield or it can be a net yield. Now, the higher the rental yield of a potential investment is obviously attractive, okay? Because it represents more money coming into your pocket each month, or whatever the payment structure is, right? Whatever the tenant has agreed to. So the rental yield can be affected by, the property, the location, the quality, the demand, and ultimately what the tenant is willing to pay versus what you paid for the property originally. So just a quick word on Dubai rental yields in general, so we can look at a bigger picture. Dubai offers, on average, very, very strong rental returns, generally compared to other global cities. The reason being is because fundamentally it's still undervalued. So if you can buy a property, if you compare the prices of buying a property in Dubai in the best location versus the best location in London, the price per square foot in Dubai will still be significantly lower. Okay, there's still a huge amount of room for growth in Dubai. Now, what that does mean is because the purchase price or the entry level of buying into the investment is lower, yet the rental prices are pretty decent and they are rising year on year, it means from an investment perspective, the rental yield is quite attractive. Okay, so that would be, if you're renting to someone on a long-term basis for 12 months, and you can also think about the short-term let aspect. So where you're renting it on Airbnb or you're giving it to an agency that are renting on Booking.com, Airbnb, Trivago, etc., etc. And basically they're giving you a premium to stay in your property for a couple of nights. Now, if you look at that over the year, that would be your short-term yield that's coming in. And typically that's higher than what you would see on the long-term let market. But we'll go into more detail on that later. Just what you need to know now is that rental yield is the income that will be in your property, coming from your property on a monthly basis, and it's expressed as a percentage versus the property price that you purchased at. Okay, so the higher the percentage return, the more attractive the rental income or the proposition is in general. So that's rental yield. Keep it in mind, Dubai does offer attractive rental yields both in the short-term let and the long-term let market, and that's the income generating factor, so the cash flow that you're going to get on a monthly basis. So premium areas tend to have lower rental yields. Now, this is because the price that you're paying for the property, because it's a premium area, is exaggerated or it's increased. So the rental return will be, or the rental yield will be a bit lower. Okay, whereas if you would buy a property a little bit further out where the purchase price is lower, but the rental demand is still pretty high, then you can get a really strong rental return or a gross yield or net yield, etc., etc. So you can see how it's about balancing the different factors and making sure that it's playing into your overall strategy. Are you buying the property to get as much cash flow and income on a monthly basis, or are you buying the property to make sure it increases as much as possible over time? Now, you might think, I want the property to go, up in value as much as possible, but where we get a lot of investors that are looking for cash flow and income generation is typically people that are in their older years. They say, I don't want to wait 20 years to see the property double or triple in value. I want income now to live off and to, enjoy my, retirement years effectively. Whereas you might get people that are starting to build their portfolio and they're buying at 25 to 35 and they're ultimately looking to make as much money as possible. They don't need the cash flow to live on. They want to build a portfolio, reinvest, keep growing and keep growing and keep growing. So that's where they might look at more of a capital growth play. So let's move on to that in particular. So capital growth is simply the amount of value that your property is increasing by over time, okay? Also known as capital appreciation. And this, again, like rental returns, can depend on a lot of things: market conditions, demand, the quality of the product, the location, and the general, sentiment in the marketplace. So capital growth is really where the majority of your wealth is going to come from. You're going to make far more money in terms of the property value rises versus rental income in most places. Okay? Sorry, in most cases. So looking at Dubai in particular, it does have some of the best capital appreciation rates in the world. Okay? So companies like Knight Frank forecast Dubai to be the best residential investment location on the planet in terms of the prime market. And we've seen exceptional numbers in recent years of examples where values have increased super aggressively. So if you remember in the earlier lessons, I referred to Dubai as a volatile market. Now, what that means is effectively values go up and down quickly. But where that's an advantage for investors is if you do buy at the right time from the right developer in the right location, the right property, you can really ride the wave of the appreciation and get some phenomenal returns. So you've got to think about, what is it that you're aiming for? Why are you buying the property? Is it for the income on the monthly basis? Is it to grow a portfolio and build as much wealth as possible? Is it for the lifestyle aspect? You want to come and spend time in the property and you don't really care. All you want is a good location. All these are questions that you've got to ask, and a good agent will ask those questions. So there's a couple of different things to consider there, but capital growth and rental yields are both really important. So what are a couple of things that can affect these aspects, in particular appreciation, and how do these relate to Dubai? So I'm going to roll through these quickly and give you an understanding of, how this is specific to Dubai and what you want to consider. So developer and property type. So in Dubai, branding from the developer aspect is super important, okay? So on all the buildings you see the branding, namely Emaar and Damac, especially Business Bay, you've got all the Damac stuff, and then downtown and different areas like Emaar Beachfront, you've got all the Emaar branding. So developer reputation is really important, okay? When investors and property buyers are buying property, especially if they're local, they know developer reputations, okay? So you can't get away with buying a property from a low caliber developer and then trying to get a premium price when you want to exit or when you want to sell, or even from a tenant. So it's super important when you're buying in Dubai, more so than other cities, that you buy a development or a property which has a good reputation, okay? So whether it doesn't necessarily mean size only, and we'll discuss more on this later, but it means they're considered good in the marketplace. So you get smaller boutique developers like Ellington is a good one, Ellington Properties. So they're a bit smaller, but they're renowned for product quality and for fetching a premium on the rental market, okay? So buying with them, you're going to have really good demand on exit, whereas buying with a low caliber developer that's building thousands of units and just mass supplying the marketplace, and there's no supply factor that's playing into your favor, then that's when you can have issues as well. So capital growth is affected by the developer brand massively, because when you come to exit, you need to sell your property at a certain price, right? If you've got a lot of demand because you have a good developer reputation or a good developer product, it means you can charge more. It means you can fetch a premium for the property. So that's what's affected your capital growth rate since you purchased it. In other words, to keep it simple, buy from a good developer. Okay, and the last reason why you want to keep that in mind is because the tenants in Dubai are also aware of this, particularly the high earning, executive professionals. They are extremely demanding because they do have a lot of products to choose from in Dubai. So they're not going to get a property, or they're not going to rent a property from you which is subpar, or has, a poor finish, or the paint isn't done nicely, or it has lower quality amenities on site, etc., etc. So a good developer is going to deliver on all those factors, and that in turn is going to affect your capital appreciation and the demand and the price that you could charge on the rental income on a monthly basis. Okay? And then the other aspect of this which will help appreciation is choosing a unique unit. Okay? There is a lot of supply in Dubai, so choosing a unique unit, whether that's a good view, a good layout, an above average size, etc., can really affect the appreciation and the value of which you can sell the property. Location is a massive one. Dubai is very much built out in communities, and that's how people judge, a good location. Obviously, they consider factors: is it waterfront, or is it, more of an urban area or Gulf community? But really, communities are how values and people make decisions on Dubai. Whereas if you compare that to London, for example, it's based more on postcodes and specific micro markets. So when you're buying a property in Dubai, you want to think about prime locations and really think about what is it that your property offers that others may not. Is it, near a golf course? Does it have all the amenities in the mini community, micro community? Is it near downtown? Is it near the marina? Is it on the Palm? Is it within 5 minutes to the IFC? Okay, so obviously location, kind of everyone should be aware of this, but location is really important for capital appreciation and ensuring that the values rise effectively. So that doesn't mean you have to buy in the marina, or have to buy on the Palm, or have to buy in the middle of the downtown. But is it easy to get to those places? Is it convenient? If it's a bit further out, does it have all the amenities on site? Does it have shops, hospitals, schools, pools, kids' play areas, etc., etc.? Next one, local market conditions. So obviously we want to think about the overall macro market, so the city's economic performance, population growth, employment levels, government policies, education, transport links, employers, etc. But when you're buying a specific property, you want to consider the local market as well. So as it goes back to what I mentioned earlier, does it have everything nearby? For example, how downtown would perform in terms of capital appreciation versus how Dubai South will perform in the next few years based on capital appreciation will be very, very different. If you look at the likes of the marina and downtown, they are very mature. They've been around for a long time. They're very much developed and built out. There's very little new development happening in these places, and they are very expensive to live in. So it's almost seen that aggressive growth phase already. But whereas when you look at other locations like Dubai South, Arjan, JVC, you're going to, not necessarily JVC because that is relatively mature, but I think Dubai South represents this the best. It's such a new emerging community that the value rises you see in that area, the capital appreciation, the capital growth, will far outweigh other areas of Dubai. So local market conditions are super important when you're considering the influence on the capital appreciation. Future development plans, this is a little bit more advanced that some people don't think of. They think, they hyper-analyze the specific property. But what you've got to do is look at the development in the local area, whether that's, if you're in Dubai, going to the site, or if you've got a reputable agent that's helping you, or you are an agent, go to the site, show or consider the surrounding area and show that to your client. Okay, it's super, super important. If there's a massive construction site next door, obviously that's going to be at detriment to the purchase, and it can completely obliterate the rental income, the capital appreciation, etc., because noise blocks the views, more congested traffic, etc. But not only that, what you want to do is look at the planning and the future developments that are taking place in the immediate vicinity, both in terms of buildings and also infrastructure, public transport, leisure communities, retail and commercial activity. You know, when you're buying, if you're an investor or you're advising someone, you've got to be an expert in that area. It's not good enough to say, oh, it's 15 minutes from the Dubai Marina, it's a great location. No, have a look at the development and then look at the micro market surrounding that of what's happening. Is there a tube station going in? Is there good road links? Is it easy to, you know, get taxis in quick time frame? Is it easily commutable to a workplace or a commercial environment? Does it have a community pool nearby? Yeah, as I mentioned, so one example with this would be if you buy a property in a development, there's an empty site next door, there's no construction going on, okay? But you buy the property, a year later, a developer comes in and says, we're building a building here, it's going to be 500 units. For the next 2 to 3 years, you're going to have construction from whatever it is, 8 a.m. to 4 p.m. every single day, 6 days a week. Okay, that's going to dramatically impact your investment. So it's not a case of, oh, it might block my view, or, oh, my unit's on the other side, so the view's not going to be blocked. It's the quality of life which will impact the tenants and the residents, which will influence the value and the performance of your investment. So keep that in mind as well, guys. Be hypersensitive to what's happening in the immediate vicinity, but not on a basic level, in a detailed level. This is super, super important. Okay, and then just the other aspect which will influence the capital appreciation rates would be the price that you buy at. Okay, so a lot of people say in property, it's kind of an old adage that you don't make your property when you sell. You don't make your money when you sell. You make your money when you buy. Okay, so that's super, super important. And the other thing, when you buy and you get a good deal, whether that's from a developer or from an owner, what you're doing is you're building in a contingency, okay? You're getting ahead of the market, you're mitigating your risk, and you're allowing for a bit of cushion. So if the market does slow down a bit, you've still got good, you know, profit potential there, okay? Whereas if you overpay for a high-end residence, if the market does soften, you can take a hit there on the rental income, and you know it might not appreciate much at all, and your exit strategy might be a bit more limited. Okay, so you've really got to think about the deal that you're getting in terms of how that might affect you in 5 years, 10 years, 15 years, not just how it affects your rental income in the first 6 months. So that finishes up this module, guys. There's a couple of influencing factors there that you want to think about, which will affect your rental yield and your capital appreciation rate. So obviously that's important to consider as an investor, and then going into that extra level of detail. And then if you're a broker, it's important to, you know, advise your clients on this. You are the expert. Don't rely on them to just read the brochure and say, what's the price per square foot? What's the rental yield? How far is it from downtown? No. Go into extra detail. Tell them about the community nearby. Tell them about the competing projects nearby. Tell them about the government initiatives and plans nearby, and really go that extra mile to build the picture and to, you know, make sure they're making an informed decision. So I hope that helps, guys. On to the next one.